Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is December 11th of 2023, that last month of the year. And as we've seen here over the last month, we've seen the market continue to both bounce and then sort of consolidate here in a sideways fashion. The big message from last week is that we expected markets to start to consolidate some of those gains. We're in an overbought condition. We believe that we remain in a short-term overbought zone. And so, that gives us a chance to take some profits off the table in certain areas of the portfolio that have run up, while also looking for opportunities that perhaps have not participated in the recent run up. And those areas would include like the banks or energy stocks versus tech and growth, right? So we're going to go through all of that this week, as well as some of the struggles we've seen in the price of oil. Now, that really has not translated into energy stock weakness with the exception of a couple of days, but we'll go through that and what all of that means, not just for the rest of this month, but into 2024. So let's go ahead, get started. The title of this week's presentation is What If Inflation Returns? And what we're really trying to do with this title is set our viewers up, set our investors up, our advisors up with this idea that quant factors really do drive a lot of the short-term price action that we see in the market. And then longer term, you see the fundamentals play in. But it's good to know how the market plumbing works. So when you're looking at price action on any given day or any given month to month, it introduces a lot of emotion. Hey, I'm up a lot or I'm down. Why did this happen? There must be something wrong with the company, or the company must be taking off and doing great things. When in reality, most of that noise is driven by what we call these quantitative factors that are driven a lot by algorithms. So we'll go through that this week. So the three big things: growth versus value. Where are we in that battle between growth versus value stocks? What are the factors that are going to drive investor money one way or the other? Number two, we had that round trip for energy stocks, popped at the beginning of the week, then got 2 days of weakness, then sort of started to recover here at the back end of the week last week. And then the impact of Japan. Some huge moves in both the Japanese bond market and the currency market. We think that has huge ramifications for not just US bonds and interest rates, but also equity allocations. And we'll explain what all of that means as we delve into the presentation. But, one of the things that we've seen, obviously, is the price of oil continue to come down. And there's really sort of two ways to look at it. There's that potential perception that we see out there versus the potential reality, right? And the perception, of course, is that the fundamentals are driving the price of oil. And you see that through rising inventories and falling demand. That's the reason for the declining price of oil. Now, in reality, what we're actually seeing is that most of this is being driven by quant factors. So quant funds, algorithms that are really sort of more paying attention to interest rates, currency movements, and then shifting their allocations and their larger funds between growth and value stocks. And energy is considered a value component. And so those quant factors are actually having a much larger impact on price. And that's really because we've seen falling interest rates over the last month, which have driven that allocation, and then that rotation out of value into what we call bubble growth stocks, right? So a lot of the junk growth stocks, there's lots of great growth stocks in there, like Google and Microsoft and Amazon and whatnot. But even those stocks are seeing incredibly rich valuations. So what do we actually want to look for here? So the blueprint that we use to try and navigate the quant world is, what is inflation versus economic growth doing? How that, when you see inflation go up or down, or the economy accelerate or decelerate, that drives interest rate expectations. And so if interest rates are going up, you tend to get a rotation into value stocks. If interest rates are coming down, you tend to get a rotation into growth stocks. So that drives our growth versus value trade. And then within that, that's really going to look at and determine, do bank and energy stocks and certain areas like consumer staples and other areas, do they outperform, or does high charge tech and and high-powered, young, emerging consumer stock companies that perform. It's a lot of it is in the short to medium term driven by that. Now, long term, the fundamentals will always outweigh that. But we just wanted to kind of provide that blueprint for everyone. So here's the reality in terms of what's happening with oil, right? So the yellow line here are oil inventories in 2022. The dotted line here is the 5-year average of oil inventories. And then this blue shaded area is really the 5-year range in 2022 and before that. Here's what we see in 2023. Throughout 2023, oil inventories have been trending below this 5-year range. So the lowest inventory levels we saw in the last 5 years are in 2022, and we're below those levels. So when people are saying that inventories are rising, yes, they're rising off the very, 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 very aching bottom of this range. But what we see is that even right now, if this data point was in isolation without the rest of these data points, this would be the lowest level of inventories over the last 5 years. So our point here is that inventories continue to trend at dangerously low levels. And one has to remember that seasonally, oil inventories tend to rise during the winter because driving season tends to decline, right? So seasonality, miles driven, is highest in the summer, lowest in the winter. The fact that we're at these very dangerously low levels in the winter months, I think speaks to the fact that we actually are continuing to see a rise in oil demand through higher miles driven, both in the US and overseas. We're seeing supply that is not really responding in any way. US production has come up, but a lot of that is from the private operators that are non-public companies. And then, of course, OPEC continues to come down in terms of its production. And I would note that Vladimir Putin was in the UAE over the last week, and we really don't know what they've met about, but the UAE is the one country that sort of has been at the sidelines increasing production while the rest of OPEC has been decreasing production. So we don't know what they met about, but I do suspect that the market might be underappreciating the discipline and the determination of OPEC to bring down production levels. So we'll see what happens over the next couple of weeks, but we will say that energy stocks remain in an incredibly discounted territory, huge free cash flow yields, rising dividends, and valuations that are trading, anywhere from 6 to 8 times earnings, maybe 9 times earnings, at almost a 10-point discount to the S&P 500. So what does all this mean? We need to understand interest rate expectations to really understand the price, how the average stock is moving. Growth versus value, for example. How will that impact asset allocations? And then we need to adjust portfolios today, even if we're early, right? We could be early by a month and a half, right? And that's okay. One of the big lessons that we learned as an asset manager in 2022 was that by not focusing entirely on what our 2021 signals were telling us, we shifted money out of that value trade because we thought the trades were taking too long to pan out. Had we stayed in those positions, we would have actually had an incredibly strong and fantastic 2022 in the face of a bear market. So really important to be disciplined and not get too worried about the short-term moves in price, because a lot of it is just algorithm driven. So what do we know? So that's a question for 2024. What do we know? Fiscal spending in the US is set to accelerate in 2024. Why is that? The Inflation Reduction Act, which I do think is a pretty hilarious name for a bill that increases spending. The Inflation Reduction Act is really the spending behind that bill is set to accelerate in 2024. That's not by a mistake. We have an election in 2024. Republican or Democrat, spending tends to increase during election years. Why? Because it gooses GDP and makes the incumbent look better during an election year. That's why incumbents are harder to defeat. Now, The other big thing we need to know is that most of the spending within the Inflation Reduction Act takes place in 2024. So that 1 trillion plus price tag, most of that's going to take place in 2024, which means that higher spending drives up economic growth, but it comes with a price. Higher economic growth, notional growth, and higher inflation, right? So that's what we think may happen in 2024, is that everyone is now shifted to this side of the boat of expecting interest rate cuts. We are not expecting interest rate cuts. The biggest mistake the Fed made in the 1970s was the fact that every single time inflation came down to around 3 or 4%, oh, let's cut rates. Guess what happened? Inflation bottomed and swung right back up. The Fed right now has a great situation on its hands. The economy remains durable and strong. 200,000 jobs created last Friday over the month of November. There's no rush to cut interest rates. And at some point, the market's going to price that in. And when the market does price that in, we should see a reacceleration in long-term rates, a steepening of the yield curve, and a shift out of growth and into value. And that's what we're trying to position for right now. And the other factor is this potential of Japan abandoning ZIRP, or zero interest rate policy. So we'll get into that here right now. A huge event this week. The Japanese yen massively appreciated against the US dollar. I mean, we're talking a 2-3 standard deviation move in one day. And you can see that here by this giant spike that we saw here on Thursday. It is significant because currencies tend to move and drive off of interest rate expectations and monetary policy within a certain country. So what does this violent move mean in the Japanese yen? Well, it potentially means that the Japanese are moving away from zero interest rates. So the only country that remain on zero interest rates. And you can see the market has started to price that in. We're at 0.76% versus obviously zero and negative earlier this year and last year. Now, Japanese interest rates, so institutionally on Wall Street and across the world, currencies or capital doesn't have borders, with the exception of China and some other countries for the most part, can freely move across the globe. So when one country has a super low interest rate, what investors do is they tend to borrow in that currency and then they buy assets overseas, right? It's called the carry trade, right? Low funding costs, higher yields elsewhere, capture the spread minus the cost of hedging your currency risk. In Japan right now, those low rates, 0.76 versus 4.2% in the US, obviously a big differential, are anchoring, in our opinion, global interest rates. As Japanese rates rise, what you're doing is you're lifting the floor up on interest rates, and then whatever that spread is of Japanese rates versus US rates or European rates or Canadian rates, those tend to be shifted upward as a result of that. And so if Japan abandons zero interest rates and their rates go up, we think that is a ripple effect in terms of what will happen both in US interest rates, Canadian, ECB, and of course UK rates as well. So what's that mean for a potential framework for 2024? Government spending accelerates. Inflation and growth expectations rise as a result. And then, of course, that in combination with Japan abandoning 0% interest rates, interest rate expectations begin to rise higher for longer, not cuts, but rises. And right now, consensus in the market is for rate cuts. So if we shift those expectations from cuts to increases, we think this drives value over growth in 2024. And we can see that in the charts, right? When we look at the Russell 1000 growth relative to value, and then the Russell 2000 growth relative to value, there's this huge divergence that has taken place, right? So when we look at over the last few years, going back to 2020, every single time we got to this peak, we've seen large cap growth relative to value roll over. And this peak, we nailed it. We sold tech, we got out, And then we question it on this bounce. And that was our mistake in 2022 that led to that year's underperformance. Not this time. We're going to pay attention to our signal, right? So we see this rolling over again, hence why we've been trimming back our growth positions. We've been increasing our value position. So you notice our tech weight has started to come down again as we've had that 5 or 6 week rally, and we're rotating back into areas like the banks and energy and consumer value and those types of areas. That's what we're really focused on, right? So the other harbinger is what's happening down cap in the market. So when we look at smaller stocks, that growth versus value trade has rolled over quite pronounced, pardon me. And longer term, when you look at going all the way back to 1999, we haven't seen growth outperform value at these peak levels since the 2000 bubble. And every time we get to these bubble levels, we get these big, sharp corrections. And the last time, of course, was in November of 2021. We want to really, really pay attention to this. This is something that we consider very dangerous. If you're in growth stocks right now, you've been offered a reprieve based on what happened with growth stocks a year ago. Take that chance and offload some risk and consider some value stocks in our opinion. We see that playing out. Banks are starting to break out relative to the NASDAQ, right? And the chart we don't have on here is gold stocks, for whatever reason, they've started to break down again, right? Over the last week or so. And gold tends to rise as real rates and real rate expectations come down, not up. And when real expectations start to rise again, gold tends to break down. It's that classic paper versus physical, right? If you have gold, doesn't have an interest rate. It's like a zero coupon bond, right? And so if rates are going up, it really depreciates the value of a 0% asset. So that's really what we're paying attention to. So what is the market trying to tell us why banks outperforming and gold breaking down? Well, we think it's it's the first signs of that growth to value shift. So the areas that we're focused on: energy stocks, banks, durable and emerging consumer brands with high free cash flow yields, and then small cap over large cap as that breadth expands within the market. So in summary, don't be the garbage man. We've kind of kept that title up there. Quant factors are going to have a huge impact on short-term price. Understand what it means and what it doesn't mean. Number two, government spending is set to ramp up in 2024 to goose growth, but goosing growth means goosing inflation in our opinion. Lastly, higher rate and inflation expectations may lead to an allocation out of growth and into value. So that's what we got for you this week, 888-543-3776. Look forward to any questions or responses and have a fantastic week. Thank you.